The United Kingdom is facing three simultaneous crises converging in 2026. And nobody is talking about how bad this is actually going to get. The economy is expected to grow just 1% this year. The NHS has 7.36 million people waiting for treatment. 1 in 9 people in England are queued for surgery or specialist care. And the government is borrowing over £100 billion, while debt climbs toward 104% of GDP, leaving almost no room to respond when things get worse. These are not separate problems, they are connected. The fiscal crisis limits NHS spending. The NHS crisis forces people into private healthcare, draining money from the economy. Economic stagnation means tax revenues cannot close the deficit. It is a doom loop, and 2026 is the year it accelerates. Here's what makes this different from previous United Kingdom downturns. There's no obvious way out. Interest rate cuts will not fix structural productivity collapse. Government spending increases crash into fiscal limits, and the entire system is built on assumptions that stopped working years ago. If you want to understand what happens when a rich country runs out of options, watch what happens to Britain over the next 12 months. The economic forecasts for 2026 are grim, and that's using the optimistic numbers. The Confederation of British Industry projects 1.3% growth in gross domestic product. KPMG and Oxford Economics both forecast 1%. The OECD says 1.2%. Every major forecaster is clustering around the same dismal range, 1% growth, maybe a bit more, definitely not enough to solve any of the United Kingdom's problems. For context, that's slower than the United Kingdom grew in 2025. The economy is decelerating, not recovering. But the headline number hides how weak the underlying picture actually is. Private sector demand, businesses investing and consumers spending, is barely growing at all. The only reason the UK is not in outright recession is government spending, which surged after the autumn budget. Strip that out, and you are looking at an economy that is essentially stagnant. Business investment is projected to grow 0.9% in 2026. That is pathetic. Companies are not expanding capacity. They are not hiring aggressively. They are not betting on the future. Why? Because they do not see growth coming. Consumer spending is forecast to increase just 1%, weighed down by slowing wage growth and higher taxes. Exports are expected to grow 1.8%, down from earlier projections, as global trade tensions and Brexit frictions continue to bite. The labour market is softening. Unemployment is forecast to rise to 5.1 or 5.2% in 2026, up from around 4% in recent years. That might not sound dramatic, but in a country where the workforce is already stretched thin, rising unemployment signals that firms are pulling back. Wage growth is slowing from over 4% to around 3% by mid-year. Real income growth, wages adjusted for inflation and taxes, is grinding to a halt. And inflation is not helping. The Bank of England's target is 2%. But inflation in 2026 is projected to average 2.5 to 2.6%. It will not hit the target until 2027. That means interest rates stay higher for longer, borrowing costs remain elevated, and the squeeze on households and businesses continues. The Bank of England is expected to cut rates twice in 2026, bringing them down to 3.25% or 3.5%. That is still restrictive. That is still higher than businesses and consumers are comfortable with. This is what economists call stagflation light. Growth barely above zero, inflation above target, rising unemployment, falling real incomes, and no easy policy fixes. The third quarter of 2025 saw zero growth. Flat. The economy did not expand at all. October and November contracted. The UK entered 2026 with negative momentum, and all of this is happening while other major economies are growing faster. The United States is projected to grow over 2%. Even the Eurozone, which has its own problems, is outpacing the UK. Britain is stuck, and the thing that is keeping it stuck is productivity. Productivity, output per worker, is the single most important driver of long-term growth and living standards, and the UK's productivity performance is catastrophic. By the fourth quarter of 2027, productivity is projected to be approximately 2% below its already weak trend before COVID. That means the pandemic set the UK back, and it has not recovered. Worse, productivity is now 24% below where it would have been if the UK had maintained its trajectory before 2008. Let that sink in. British workers are producing 24% less per hour than they would have if productivity had kept growing at the rate it did before 2008. That is 18 years of stagnation, nearly 2 decades where output per worker barely budged. This is not a temporary blip. It is a structural collapse, and it explains everything else. Low productivity means low growth. Low growth means stagnant wages. Stagnant wages mean weak consumer spending. Weak consumer spending means businesses do not invest. And without investment, productivity stays low. It is a cycle, and the UK has been trapped in it for nearly 2 decades. What caused this? Multiple factors. Underinvestment in infrastructure, skills, and technology. Brexit uncertainty, discouraging long-term business planning. High energy costs after the war in Ukraine. Chronic underinvestment in research and development. Poor management practices. An economy increasingly dominated by low productivity service sectors. And a financial system that channels capital toward real estate and consumer credit instead of productive investment. The Office for Budget Responsibility is blunt about this. It says weak productivity growth remains a critical drag on the economy, and it will limit the UK's long-term growth prospects and living standards. There is no sugarcoating it. Britain is getting poorer relative to where it should be, and there is no sign that is about to change. Brexit isn't helping. By 2025, Brexit had reduced UK GDP by 6 to 8% compared to remaining in the EU. Investment is 12 to 18% lower. Employment is 3 to 4% lower. Productivity is 3 to 4% lower. Trade intensity has not recovered, while the rest of the G7 has moved on. The Office for Budget Responsibility estimates Brexit will reduce long-run productivity by 4%. The impact accumulated gradually as trade barriers rose, uncertainty persisted, and firms diverted resources from productive activity. Economists were right about direction and magnitude. They were just wrong about timing. They expected a fast, sharp hit. Instead, it has been slow and grinding, harder to see and harder to reverse. And while Brexit is permanent damage, it is compounding an already broken system. The UK was struggling with productivity before Brexit. Brexit just made it worse. None of this would matter as much if the government had room to maneuver, but it doesn't. The fiscal situation is dire. Public sector net debt stood at 94.5% of GDP at the end of October 2025. The OECD projects it will hit 104% by the end of 2026. That's approaching the highest levels since the early 1960s, when the UK was still paying down World War II debt. And unlike the 1960s, when debt was falling, UK debt is rising. The government deficit for the fiscal year ending March 2026 is budgeted at £118 billion. In the first 6 months alone, the deficit hit £100 billion, the second highest half-year borrowing on record outside the pandemic. Tax revenues are rising, but not fast enough. Spending is increasing, but faster than revenues. The gap is widening, not closing. Debt interest payments are eating up more of the budget every year. Net debt interest is expected to rise from 7% of non-interest receipts in 2024 to 2025 to 8% by 2029 to 2030. That's money that can't be spent on healthcare, education, infrastructure, or anything else. It's just servicing debt. And as interest rates stay elevated, that burden grows. Raising taxes is politically toxic. The government already froze income tax thresholds through 2030, which will drag 4.8 million more people into the higher tax rate. National insurance contributions are rising for employers, which will squeeze hiring and wage growth. There is not much room for more tax increases without triggering a backlash. Cutting spending is even harder. The NHS is already in crisis. Education is underfunded. Infrastructure is crumbling. Defense spending is being increased to meet NATO commitments. Social care is collapsing. Where do you cut? And breaching the fiscal rules undermines credibility with bond markets. If investors think the UK cannot manage its finances, they will demand higher interest rates to hold UK debt. That makes the problem worse. This is the fiscal trap. Growth is too slow to generate the tax revenues needed to close the deficit. But the government cannot boost growth through spending because it is already borrowing too much. And it cannot cut interest rates fast enough because inflation is still above target. There is no easy way out. The NHS waiting list in England stands at 7.36 million cases, representing 6.23 million unique individuals. That is 1 in 9 people waiting for treatment. It peaked at 7.8 million in September 2023, so it has declined slightly, but it remains catastrophically higher than 4.6 million in December 2019. The NHS Constitution promises 92% of patients will start treatment within 18 weeks. That standard has been unmet since February 2016. As of mid-2025, only 61.3% of patients were waiting less than 18 weeks. The government's March 2026 target of 65% will not be hit. Current trends point to 63.4%. Close, but not good enough. Median wait time is 13.6 weeks, nearly double the pre-COVID 7.6 weeks. Cancer care is worse. Only 68.8% of patients receive treatment within 62 days of urgent referral. The target is 85%. Emergency care is broken. 4-hour waits at accident and emergency departments are routine. Ambulances are queued outside hospitals, unable to hand off patients because there are no beds. The Royal College of Emergency Medicine estimated in late 2022 that 300 to 500 people were dying each week because of delays. That was 3 years ago. The situation has not improved. The consequences are predictable and devastating. People are going private. The self-pay market for private healthcare is exploding. Those who can afford it are bypassing the NHS entirely, paying thousands of pounds for hip replacements, cataract surgery, and diagnostic scans. Those who cannot afford it wait in pain, miss work, and watch their conditions worsen. This creates a two-tier system. If you have money, you get treated. If you do not, you wait. That is not what the NHS was supposed to be. The founding principle was care based on clinical need, not ability to pay. But that principle is eroding in real time. The government is trying. It allocated additional funding in the autumn budget. It set interim targets. It is expanding surgical hubs and diagnostic centres, but none of it is enough. The backlog is too large, the workforce is too stretched, and the funding increases are being siphoned off by agency staff costs, inflation, and inefficiencies. Health spending in the UK is already 43.1% of total government spending on goods and services, up from 31.6% in 1997. The NHS has become so expensive that it crowds out other priorities. But despite spending more, outcomes are getting worse. The UK ranks 9th out of 11 in healthcare outcomes among advanced economies. Wait times are among the longest. Satisfaction is plummeting. And here is the kicker. The NHS crisis is an economic crisis. People waiting for hip replacements cannot work. People waiting for mental health treatment cannot be productive. People in chronic pain withdraw from the labor force. The Institute for Public Policy Research estimated that if the government met its waiting list targets, it would generate £73 billion in economic benefits over 5 years, largely from people returning to work. But the government is not going to meet those targets, which means the economic drag continues, which means tax revenues stay depressed, which means the fiscal situation stays dire, which means there is less money for the NHS. The doom loop again. The most likely scenario is managed decline. Growth limps along at 1%. The National Health Service continues to deteriorate slowly. The government borrows £118 billion and hopes bond markets stay patient. Productivity stays flat. Brexit damage accumulates. The private sector stays cautious. Consumers pull back. And the UK muddles through another year of stagnation. But there are risks. A global recession would hit UK exports and push growth negative. A spike in energy prices would reignite inflation and force the Bank of England to keep rates high. A fiscal crisis, if bond markets lose confidence in UK debt, could force emergency austerity. A wave of business failures could push unemployment sharply higher. Any of these would turn managed decline into something worse. The deeper problem is that none of the challenges facing the UK have obvious solutions. You cannot fix productivity with a policy tweak. You cannot undo Brexit overnight. You cannot rebuild the NHS without money the government does not have. You cannot cut interest rates when inflation is above target. You cannot boost growth with fiscal stimulus when debt is at 104% of GDP. Every lever is jammed. Every tool is blunt. Every option has brutal trade-offs. Other countries have faced similar challenges and found ways through. Germany reunified and rebuilt its economy. Japan has managed decades of low growth without collapsing. The United States rebounded from the 2008 crisis. But those countries had advantages the UK does not. Germany had the euro and access to EU markets. Japan has a massive trade surplus and domestic savings. The United States has the dollar as the global reserve currency and enormous internal markets. The UK left its largest trading bloc, has chronic trade deficits, and does not control a reserve currency. It is a mid-sized economy trying to punch above its weight, and it is running out of punches. 2026 will not be the year the UK collapses in a dramatic, visible way. There will not be a sudden crisis, a government default, or a currency meltdown. But it will be the year the slow decline becomes undeniable. The year waiting lists break 8 million. The year debt hits new highs. The year growth stays stuck at 1% for yet another year. The year people stop believing things will get better. Collapse does not always look like chaos. Sometimes it looks like a rich country slowly becoming less rich, a healthcare system slowly becoming less universal, and a government slowly running out of options. That is the UK in 2026. Not a bang, a whimper. And once you see it, you cannot unsee it.